Hi, this is Ajay Anand and welcome to Social Science classes from excelup.com. In this lesson, you will be learning about money and credit. You will learn about the barter system, different forms of money, loan, terms of credit and sources of credit. So, what is money? Money is a medium of exchange. So, once you give, suppose if you want to have a packet of chips from a shopkeeper, you give a note of 20 rupees to the shopkeeper, and in lieu of that, the shopkeeper gives you a packet of chips. So, here the 20 rupees note is the medium of exchange. It is money. Before the advent of money, people exchange a particular item for another item, and this system was called the barter system. So, it was in vogue, it was in fashion because there was no alternate arrangement. The biggest problem with the barter system was double coincidence of wants. So to understand this, let us take an example. There is a person, he is Ram and he is Shyam. Ram has a goat and Shyam has a hippopotamus. Now, Ram wants to give away his goat in lieu of a hippo, and Shyam wants to give away his hippo in lieu of a goat. So if both of them they meet at a particular place, both of them they'll be happy because now Ram gets the hippo and Shyam gets the goat. But finding a person who needs your goat can be very difficult and almost impossible for Ram. Similarly, for Shyam, it will be very difficult to find a person who may be needing his hippo, and in lieu of that he is willing to part with his goat. So this was a huge problem. So through the course of history, money developed. Initially, many items they were utilized as money, like in Roman civilization, bags of salts they were used as money. At certain places, kettles they were used as currency. At some places, even grains and black pepper they were used. But carrying those things, it was difficult. They were perishable items, and there was no standardization, and that is why money developed in due course of time. Initially, coins came into use, and later on, currency notes they came in use because currency notes they are more convenient and cheaper. In case of India, the RBI or the Reserve Bank of India, it has the authority to issue currency notes. So all the currency notes they are issued by Reserve Bank of India. The same system is in place in all the countries where a particular authority has the power to issue currency notes. Now, the benefits of money are many. So first of all, it removes the need for coincidence of wants. You do not need now a person to who may be willing to have your goat. Now you just give him the money and you want whatever you want. Now the money has liquidity. Liquidity means, so whenever you want to use the money at whichever place, you can easily use, and money is easy to carry. Now there are different forms of money. One form is bank deposit. This is the money which you keep in your bank, and you can utilize the money from your accounts. It can be a saving account, or it can be a current account, or it can be other forms of account like fixed deposit accounts. So you can utilize the money by using a check or a demand draft. Nowadays we also use the payment bank, right? So check is a small paper where you give instruction to your bank to give money to a person who is carrying the check. Demand draft is more or less similar to check, but only difference is you have to purchase the demand draft, and demand draft needs to be made in the name of a certain person or certain party. So the beneficiary, he needs to present the demand draft to the bank where he wants to encash the money. Okay. Through payment bank, you tag your bank account to a payment bank, and you can use online transaction to buy so many things, to make payments at shops, restaurants, airports, etc. Okay. Another form is credit or debit cards. So credit cards, as the name suggests, it gives credit. It gives you some advance payment which you can later repay. But a debit card is a card which allows you to utilize the money which is there lying in your bank account, right? Now let us come to credit. So credit is loan. People need loan. There are many times when a businessman, he may be in need of a loan, or a farmer may be in the need of a loan. Even a normal person may need a loan to meet out exigencies, like maybe medical expenses or festival expenses, right? So loan can be availed from various agencies, like you can take loan from commercial banks, you can take loan from the government, you can take loan from cooperative society or banks. Okay, so before giving you the loan, the bank or the lending party, it fixes certain terms of credit, and the standard terms of credit are interest rate, repayment tenure, and collateral. So interest rate is the rate of interest which the bank is going to charge. It varies. Say for example, nowadays for housing loan it is around 6% per annum. For car loan it is around 9% per annum. If you are asking for personal loan, it can be around 12% per annum. Then there will be a term for repayment tenure. So in how many years you are going to pay. For smaller loans it is usually 1 year or 2 years. For car loans it can be 3 to 5 years. For housing loans it can be 15 to 30 years. It depends. Okay. Then comes the collateral. So collateral is the thing which gives a sort of guarantee to the bank that when in case you fail to repay the loan, the bank can recover the amount, at least the principal amount, by selling of the collateral. So a house or a fixed deposit or an insurance or a vehicle or ornaments, they can be utilized as collateral, right? So this is how the standard system works. But all of this talk, it was about the formal channels of credit. What happens in informal channels? So a person can take loan from the friends or relatives. He can go to a money lender, or he can go to a landlord. So this pie chart, it shows the source of credit in rural India in 2012. Let us see what is the situation in rural India. In rural India, the commercial loan from commercial bank, it was 25% of the total loan which was disbursed. From cooperative bank, 25%. From government it was 1%, and from other institutions it was 5%. So other institutions can be non-banking financial institutions. Okay. So 25 plus 25 comes out to 50%, and this 5 plus 1, 6, that is 56% of the loan, it was dispersed through the formal channels of loans, where the rate of interest remains within the range as per specified the government from time to time. But what is the situation among these 44% portion? 8% is from friends and relatives. So you may be having lenient friend who may not charge interest, and we can easily give loan. But friends and relatives can give a loan for a small amount only. What happens if someone needs a larger amount? So there comes the role of money lender and landlords and other non-institutional avenues, maybe a shopkeeper. So these guys, they charge very high rate of interest. So if the market rate is say around 10% per annum, the rate of money lender can be 20%, 24% or 36% even. So that is the huge problem. And another problem is that these are usually cruel people. They can go to any length to recover their money. And once a person falls in the trap of a money lender or landlords, the person falls in debt trap. Now, a question may be coming to your mind that why do people go to money lenders when banks are already there? They are giving loans. Getting a loan from a bank is very difficult because you need to give so many papers, you need to give your proof of your credit worthiness, you need to give collateral, you need to have a guarantor who can give guarantee to the bank, and the process is long and time consuming. Now suppose there is a person, he is a small farmer and he needs to buy seeds and fertilizers for sowing paddy in his field. Now there is a time frame for sowing the paddy seeds in the field. If the bank at all gives loan after say 1 month or 2 months from the day when he applied for the loan, so by that time the sowing season for paddy will be over and the farmer, he won't be able to sow the paddy. So what happens? He instead goes to the money lender who can give loan within a few minutes, because the money lender, he knows the person personally. The money lender, he is confident about his ability to recover the loan, and the money lender knows that he can also use muscle power to recover the loan. So now the farmer has no other way than to go to the money lender, and that is why these people, they fall in the trap of money lenders. Now the government of India, it is trying to smoothen the availability of loan in rural areas. So the government is trying to open more and more branches of banks, or at least of cooperative banks, so that people can have access to loans. Then recently the government has also started encouraging the use of SHGs. The SHG stands for self-help groups. So it's a sort of cooperative where a small number of people, they make a cooperative and they pool their resources. They pool their savings so that corpus can be made, and if a needy person is in need of some loan from the group, then that person can be given the loan. So this has been very successful, especially among women in rural India, and women, they are utilizing now SHGs to finance small business, and they have been very successful in their endeavor. To sum up, I talked about the barter system, then I talked about the money, different forms of money, then I talked about the credit and terms of credit. At the end, I talked about self-help groups. So that's all for this lesson. Thank you.